Welcome to our newest installment of A View from Legal Street. Help us help you get paid. It's our series of short videos of tricks and tips to help healthcare providers bolster their revenue cycle and maximize their reimbursement from commercial insurance companies and government payers. As always, I'm Zach Rothenberg, co-chair of the litigation practice group here at Nelson Hardiman in Westwood. We are a boutique law firm focusing exclusively on the representation of healthcare providers and life sciences entrepreneurs. Today, we'll be taking a little bit of a detour to talk with my friend Benet Heames about disability insurance. Benet is an employee benefits consultant with Marsh McLennan Agency here in Los Angeles. He works with small to middle market employers to navigate the increasingly complex health insurance markets and to provide strategic and cost-effective benefit programs that will improve the lives of their employees. One key area of Benet's focus, and what we'll be talking about today, is disability insurance, which provides meaningful financial benefits to employees in the event they are unable to work due to a sickness or accident. Benet, thanks for joining us. Can we jump right in?
Absolutely. Thanks, Zach.
Let's do it. Let's start with the basics here. What is disability insurance?
Well, disability insurance is better known as income protection, and it replaces a portion of your paycheck when you get sick or injured and unable to work. So there's two types of insurance that we see employers providing: short-term and long-term disability. Short-term is usually a weekly payment, and it can last anywhere from 3 months to about a year, depending on the state and the coverage parameters, but just giving you ballparks. Long-term disability is going to be a monthly payment that can last for 1, 2, 3 years, even all the way up to someone's Social Security retirement age, which could be a number of years. And both plans will typically replace anywhere between 50 to 70% of an individual's insured earnings that they had prior to the disability.
Now give us a sense of how it works in terms of paying premiums, making a claim for care, all that stuff.
Yeah, so these programs are usually offered by an employer, usually paid for by the company. They can be offered on a voluntary basis. I'm just going to be focusing in on the employer-sponsored disability programs for purposes of this conversation. And again, every contract's a little bit different, but high level, here's how it works. A claim starts with the inability to perform the duties of your job and a respective earnings loss. So when somebody becomes sick or injured, that typically means that they're going to have a loss of about 20% of their earnings. So most policies have a period of time that needs to pass before the claim can become payable. They call this the benefit waiting period or the elimination period. For short-term disability, it could be 7 days, it could be 14 days. For long-term disability, it could be 3 months, could be 6 months, but it's a period of time. Think of it like a deductible of time before your claim starts, right? And the reason for that is just because you don't want a claim being started for somebody that missed 1 day of work because they got, stomach flu or something. So a claim works in a number of ways, but again, starts with somebody having an event, and then it goes to having an attending physician, and that's going to provide the insurance carrier with information about the medical condition that's being treated, the treatment plan, and the time needed for recovery. The employer is involved because they need to verify the duties that the employee was responsible for and the corresponding payroll record. Now, there are a couple unique things here that I want to make sure people understand. Not every disability contract is the same. So it's important to understand the contract language around earnings loss. So some language from an insurance carrier will require an actual earnings loss before a claim could be paid. But we know in some situations, people have commissions that are coming in from, sales that they made a month or two earlier. Right. So when they have a disability, they may not actually have an earnings loss because of commissions or even billable hours, for an example. So some contracts have been written to say unable to earn 80%. And so what that means is that because somebody has a disability and they're unable to earn that full 100%, that actually can trigger a claim to start earlier. I want to give you a couple examples of claims. Most common for short-term disability is going to be pregnancies. Usually that's about 6 weeks. And for C-section, that'll be about 8 weeks. And then the other most common are going to be musculoskeletal conditions. And that's going to be like arthritis, back pain, sciatica. And then the third most common category is going to be mental health issues like depression and anxiety.
Okay. We'll touch on some of that a little bit more in a minute. But first, Let me ask you this. So I think most of our viewers today are probably mainly owners and operators of healthcare businesses, as opposed to employees. From their perspective, from where they sit, what is the benefit of offering disability insurance to their teams?
Great question. And as an owner or a partner in a healthcare business, you have to plan for the loss of income from a revenue generating partner. And we see this often with physician groups as well as attorney firms, where you have a couple key partners or revenue generating partners. So what happens in the event of one of those partners becoming diagnosed with cancer and needing to recover from a period of time, the business actually suffers a loss because of that revenue producer out. So disability contracts can be structured where not only would the claimant receive the loss of earnings benefit, but the business can receive a loss of revenue benefit for that specific part. So that's kind of the business owner partner hat to wear. But when you're thinking about your employees and why it's a good benefit to offer, you're already invested in hiring and training employees. So turnover is pretty expensive, right? So if somebody goes out on a leave of absence, what we found is that insured employees have a higher rate of return back to the work site than those that don't have coverage. And it's because insurance carriers have return to work programs and reasonable accommodation benefits. That means somebody's going to go on a medical leave of absence on a disability claim, and then the insurance carrier is going to work with you, the employer, to figure out how to get that employee back to work. It could be things like putting in a standing desk, changing the lighting in the area so that they don't get migraines. So just a couple examples of why we see employees who are covered under short-term disability actually return back to work faster and more frequently than those that don't have coverage.
That makes a lot of sense. Let me ask you one more question here. Now, we've all heard in the news recently that mental illness and addiction in particular have been on the rise, particularly over this crazy past year. How does disability insurance work for mental health in particular?
So mental health claims are covered by both short-term and long-term disability benefits, but there are some exclusions and limitations to be aware of. Starting with long-term disability benefits typically have a 2-year cap on mental health related conditions. They also typically have a pre-existing condition exclusion for the first year of a policy. So if you haven't offered this coverage before and you're putting it in for the first time, know that long-term disability will have some restrictions on covering all potential disabilities in that first year. But mental health claims, just by the nature of them, are a little hard to diagnose. So you still have to have that attending physician making sure that the individual is in a program for a medical condition. I believe that the numbers, which are about 10% of all disability claims, are related to mental health. I think they're actually much higher, but oftentimes employees don't feel comfortable going through a claims process or even talking to their employer. And you start thinking about the stigma of a mental health claim. You know, you could sit around the dinner table and say like, hey, I saw my doctor and I got high blood pressure, so I'm not going to be eating this hamburger, right? And we're got to bring those numbers down. But nobody says, hey, I saw my doctor and I'm apparently depressed, so I'm not going to be eating this hamburger, right? We just have a stigma associated with mental health. So we need to educate employees about what resources are available to them. Disability is one of those. An employee needs to know that, hey, you're covered here. If you need to have help, this is a program that can help you become more productive when you return to work. And we just need to reduce that stigma that's out there.
Fantastic. Benet, that was a lot of terrific information. Thanks for spending time with us today. I really appreciate it.
Thank you very much, Zach.
All right, you take care.